The objective of the strategy is to generate superior risk-adjusted returns by combining bond and fixed income investments across different countries, which are at different points of their business and economic cycle, to create a well-diversified fixed income portfolio. My name is Valerie Ho, and I'm one of the co-portfolio managers for the Global Bond Fund strategy. I'm just one member of a collaborative portfolio management team that has over 14 years of experience working together on average. The team, it consists of very senior members who have multiple years of experience looking at various issuers and countries through multiple market cycles. The team is led by Jeffrey Gunlock, CEO and CIO of DoubleLine Capital.
I've been working hand in hand with Valerie Ho, and we've been mostly focusing our efforts on sovereign research and now on the day-to-day management of the Global Bond Fund. Encore Coley joined us about a year ago, and he has been helping us on the sovereign research process, really rounding out the team. The global bond strategy process basically relies on four broad pillars. The first is a macro pillar where we benefit from the broad macro themes and the broad experience of DoubleLine in general. As we participate in a global asset allocation meeting that's chaired by Jeffrey Gunlock and is attended by portfolio managers from every investment group. The next pillar that we benefit from is sovereign research. One key element of the sovereign research process is putting forward standardized reports. By standardizing the factors that we look at, we can then compare relative value opportunities between countries that may have seemingly diverse profiles. The third pillar is the portfolio construction pillar. And this is really where we bring it all together. But as you can imagine, every day we are faced with new themes, new news, new market developments. So daily we're monitoring news flow, we're monitoring economic data that's presented, and we're constantly updating our current views and our current research to reflect that. The reason why we think that you should have a core allocation to global bonds is you're going to benefit from diversified sources of return. Those diversified sources of return come first from not only the fixed income exposures that you get, but you're also benefiting from currency exposures. Why is that important? Because currency and fixed income can move differently to the same economic or market news. What I mean by that is if growth starts to deteriorate in a developed market country, the currency might be hurt, but your rates would rally. So you would make money on the bonds and you could currency hedge the bonds. Vice versa, if growth is strong, you may see rates back up, which would hurt the bond side, but you would benefit in most cases from currency appreciation.
Global bonds have a very broad, deep, and growing market share. Back in 2001, the global bond market cap was $33 trillion, and over half of that was based from U.S. issuers. Today, the global bond market cap is close to $100 trillion, and the composition of that market cap has changed. Global bonds have experienced a low correlation to traditional fixed income asset classes. That is when we look at it compared to the U.S. Barclay Agg, U.S. high yield indices, as well as U.S. and international equity indices. Part of that reason for the low correlation, we think, is the diversification across countries, which have the ability to be at different stages of their business and economic market cycle. There's also the opportunity to take country idiosyncratic risks and opportunities. This can include things that are uncorrelated to broad macro trends. These are things such as new trade agreements, the political risk or opportunities, demographic trends, new resource discoveries, and these are broadly uncorrelated to macro trends that you're seeing in the global economy.
Investors need to be tactical in increasing this allocation, but with a base allocation of 5 to 10%, that should give investors the ability to outperform and gain diversified sources of return in the fixed income markets.